Hey everyone, and welcome. If you're on the path to becoming a chartered accountant, this is one of those topics you absolutely have to nail down: accounting standards. It's a fundamental piece of the puzzle for your entire career. So, by the end of this explainer, you're going to have a really solid grip on what these standards are, why they matter so much, and really how they shape the entire financial world. So let's just jump right in with a big question. Imagine you've got some money to invest, and you're looking at two different companies. Now, what if company A counts its inventory using one method, and company B uses a completely different one? How on earth are you supposed to know which one is actually doing better? It's impossible, right? If every single business just makes up its own rules, how could anyone, whether it's you, a bank, or even the government, actually trust the numbers they're putting out? And this brings us to a really famous idea, that accounting is the language of business. Seriously, think about it like that. It's the way a company tells its story, its financial story, to the rest of the world. But here's the thing. Like any language, if there's no common grammar, no shared set of rules, it's not a language at all. It's just noise, and you can't make decisions based on noise. So without that common grammar, without accounting standards, you get chaos. The reports become misleading, they're inconsistent from one company to the next, and you just can't compare them. You end up with a totally distorted picture of reality. But the moment we bring in a shared set of rules, everything changes. Suddenly, you've got transparency, consistency, and reliability. You get what we call a true and fair view of the business. And that, right there, is the whole point of accounting standards. Okay, so we've talked a lot about the why. We know why we need these standards. Now, let's dig into Section 1 and figure out what they actually are. So what are they? Well, at the most basic level, accounting standards are the official rulebook for business. They're these written policy documents that are put together by expert accounting bodies or sometimes the government. And their job is to tell everyone exactly how to handle different transactions and events when they're preparing their financial statements. It's all about making sure everybody is playing the same game by the same rules. And these standards cover four really key areas. You can think of them as four big questions that need to be answered for any transaction. First, recognition. When should we actually put this on the books? Then measurement. Okay, now that we're recording it, at what value? How much is it worth? Third, presentation. Where exactly does this show up in the financial statements? And finally, disclosure. Is there any extra information we need to share in the notes so people can understand the full picture? These four things together leave no stone unturned. So what are the main objectives here? Well, the big one is to standardize everything. You see, without standards, you have all these diverse, different ways of doing things. The goal is to bring them all together, to harmonize them. It's about taking that wild variety of options and saying, nope, this is the one standard, logical way we're all going to do it. And by doing that, you automatically get rid of the non-comparability problem and make the financial statements so much more reliable. And the benefits of doing this, they're huge. First, you get rid of all that confusing variety in how things are treated. Second, standards often force companies to disclose more information than the law might require, which is great for transparency. And the big payoff? It makes comparing different companies, whether they're across the street or across the globe, so much easier and more meaningful. Now, it's really important to be realistic here. Accounting standards aren't perfect. They do have some limitations. For one, sometimes there's more than one perfectly logical way to account for something, and that makes it super tough for the rulemakers to just pick one and declare it the winner. And here's the other biggie. Standards can never, ever override the law. They have to fit within the legal system of a country. The law always comes first. Okay, that leads to a pretty obvious question. Who actually writes these rules? Let's dive into Section 2 and take a look behind the scenes at how accounting standards are actually made here in India. The main body you need to know about in India is the Accounting Standards Board, or the ASB for short. It was set up way back in 1977 by our very own ICAI, the Institute of Chartered Accountants of India. You can think of the ASB as the primary workshop where these standards are formulated. But who's actually on this board? Well, it's not just a bunch of accountants sitting in a room talking to themselves. It's designed to be a fully consultative and transparent group. You've got people from industry. Think big groups like ASSOCHAM, CII, and FICCI. You've got regulators, academics, and even representatives from government departments. And this is so important because it means the standards they create aren't just good on paper. They're practical and they actually work in the real world. And look at this process. It's really thorough. It shows you that a standard doesn't just appear out of nowhere. First, the ASB identifies an area that needs a standard and gets a group of experts on it. They create a draft. But then they don't just publish it. They send it out to key bodies like SEBI, the stock market regulator, and the CBDT, the tax guys, for their input. Then they release what's called an exposure draft to the public. That means you, me, anyone can send in comments. Only after they've considered all that feedback do they finalize the standard and send it up to the ICAI Council for the final green light. It's a long consultative journey. So we know who makes the rules and how they do it. Now, for Section 3, let's look at who actually has to follow which rules. Because, and this is key, it's not a one-size-fits-all situation in India. Basically, India has a three-tiered system. You can see it clearly here. At the top, you have the Indian Accounting Standards, or Ind AS. These are for the big players, all the companies listed on the stock exchange, big financial institutions called NBFCs, and any other company with a net worth of 250 crores or more. Then, for companies that don't fall into that category, they follow the regular accounting standards, or AS. And finally, for businesses that aren't companies, like partnerships or sole traders, the ICAI has its own set of accounting standards. Okay, a quick but very important heads up. This message comes straight from the ICAI's own material. We're about to look at some lists of standards, but please do not try to memorize them. This is not part of the syllabus for memorization. It's just to give you a general idea of what's out there. And here's just a quick taste of some of the key accounting standards. You've got AS1 on accounting policies, AS2 on valuing inventories, AS9 on revenue, all the way to more complex stuff like AS26 for intangible assets and AS29 for provisions and contingent liabilities. Again, no need to memorize, just get a feel for the range of topics they cover. Just a quick word on Ind AS, which we mentioned earlier. The key thing to know is that these are converged with the global standards, which are called IFRS. Converged basically means we didn't just copy-paste the international rules. We adapted them to fit India, but made them super close. And why did we do this? Simple. To make our biggest companies understandable to international investors, and to make it easier to do business globally. Phew, okay. We've covered a ton of ground. So for our final section, let's do a quick recap of the main points and then try out a few practice questions to see what stuck. All right, if you're going to remember anything from this, make it these 4 things. The whole purpose is to make financial reporting transparent, consistent, and comparable. The benefits? You reduce confusion, get more disclosure, and make comparison way easier. The limitations? Remember, standards can't override laws, and sometimes picking the one best way is tricky. And finally, the process in India is run by the ASB, and it's very open and consultative. Got it? Good. All right, time for our first practice question. True or false? Accounting standards can override the statute. Think about that hierarchy we talked about. And the answer is false. Absolutely false. The law of the land is always the boss. Accounting standards have to be framed within the existing laws. They can't ever override them. Okay, question number 2, multiple choice. The main purpose of accounting standards is to A. Harmonize accounting policies, B. Eliminate the non-comparability of financial statements, or C. Both of the above. What do you think? The correct answer is C. Both. This is a great point to remember. Harmonizing policies is how they do it. It's the tool they use to achieve the ultimate goal, which is to eliminate non-comparability and improve reliability. And for our last question, let's go with a theory one. Can you list the main advantages of setting accounting standards? Just think back to that benefit slide. Exactly. The main advantages are ensuring uniformity and comparability. You could also mention reducing those confusing variations, mandating better disclosures, and just generally making it easier to compare financial statements. It all comes down to making the information more useful for everyone. And that brings us to the end of our deep dive into the fundamentals of accounting standards. I'll leave you with one final thought to chew on, though. With businesses going global and technology completely changing the game, think about crypto, AI, all of that, what do you think is the next big challenge for these standards? How will the rulebook have to evolve? Because one thing's for sure, accounting never, ever stands still. Thanks so much for joining me.